took the elevator down from the executive offices on the 15th floor to the ground floor, went into the bank branch. And again, had a little chip on my shoulder, and I just went over to this woman who was on the platform. I don't even think I introduced myself. I just said, look, told that you have customer profitability information. And she goes, oh yeah. It's right here. She brought out this big old printout of everybody in the bank branch. Thing must have been 2 inches thick. And I go, well, how do you use it? She goes, oh no, we don't use it because it's not accurate.
Welcome to the Operate Podcast, where we give you a behind-the-scenes look at company building from the perspective of the builders themselves. This is how we operate.
Welcome to the Operate Podcast. I'm Kerry Ransom. Today's episode is sponsored by BankTech Ventures, the first strategic investment fund designed for the community banking industry for community bank innovation and investment. BankTech identifies leading products and technologies for community banks, works with the founders and management teams of those companies to maximize their impact in community banks and ultimately their businesses. If you're a bank looking to innovate and invest in your future, or a founder who wants to work with banks, reach out to BankTech Ventures at banktechventures.com. My guest today, I'm really excited to have, is Tom Brown. And Tom is the CEO and founder of Second Curve Capital. They are an equity investment firm focused exclusively in the financial services sector. Tom's had an incredible journey and career in banking as well as investing, starting as a Wall Street analyst where he was top rated many times for his banking industry analysis. He then headed the North American Financial Services Group at Tiger Management before, about 25 years ago, founding Second Curve. His fund has consistently and significantly outperformed industry benchmarks, and I know as recently as last week, it is doing very well for his investors. He also publishes one of the most influential and noteworthy banking newsletters called Tom Brown's Banking Weekly. And many CEOs of banks I know find it to be some of the most essential reading that they have. He has a very unique approach. I know that he goes very deep as well in understanding how banks operate, including at times visiting branches and offices and customers and going far deeper than I think most do. He will try to understand what they're doing on the front lines, what they're doing in their back offices. And I think as an analyst, that's probably one of the things that differentiates him from most others, not just in banking, but probably in any industry. Just that willingness to go deep. And I'm guessing it's his curiosity that drives him there. I have really enjoyed the few times we've been able to connect and get to know each other. And I'm excited to record this conversation so you can get to know Tom a little bit better as well. Tom, it was great to see you last week. Thank you for including me in your amazing event. And thanks for making time to chat today.
Well, I'm glad to be with you. I think you do a great service for the industry.
Well, appreciate you. Well, let's start. I kind of teased a little bit of your career trajectory, but let's start there and tell the story from your standpoint. How did you really start as, an analyst all the way to running your own investment fund focused on banks?
Well, all I knew when I graduated with an accounting and finance degree from Miami of Ohio was I wanted to help other people make money in the equity business. So I had some advice, and a friend steered me to a mutual fund company. And that's where I started. And when I started, they said, well, we're going to make you the chemical industry analyst. And I thought that's not a really good fit for me. At that point, I was a beggar, not a chooser.
Sure.
And then at the end of my first year, they said they were happy with my work and they wanted to expand the work, and they were going to give me the oil service industry. So this was in 1980 when the oil service business was booming. And I said, that's great, because as an analyst, you got paid by how much money they had in your area. And then, so I said yes. And the next day, my research director came in. He said, "I've changed my mind." He says, I'm going to put you in charge of financial services because I think there's going to be some dramatic change ahead."
Mm.
And I can't thank that individual, Ken Newtell, enough because
Mm-hmm.
he was right about the deregulation and the change. And that change has only increased. That's the
That's right.
amazing thing. Since 1980, it just keeps getting faster and more dramatic.
That's right. Well, and I think that, I was going to ask, and I think you kind of answered it. Like, what's kept you focused there? Is it that? Is it the fact that it just keeps changing?
That and it was a natural. So the idea behind looking at chemical companies and coal companies and all that I could do, but just covering financial services and being a service industry was something that seemed to be a better fit for me. So
Hmm.
I really enjoyed the change and the industry itself.
Well, I talked about how you've done a lot in your work, and you write about this where you're going to the front lines, or you're getting into the bowels. What led you to conclude that how important that was as you were analyzing banks to really get deeper into them?
So it was really the early 1990s, and I had written these reports, one each year, on the future of banking,
Hmm.
and they were widely read by bank managements. And when I'd go around to see them, they would say, "Well, we're doing all that." And I said, "Well, that's great, but I don't really see it in the performance numbers." And finally, I just said, "You know what? Everybody says they're doing
Hmm.
leading edge things, and I can't figure out who's blowing smoke up my backside and
Hmm.
who's actually doing it." So I needed to start. The only way I knew is to test things out.
Sure.
Yeah, I started applying for every credit card online that I could.
Hmm.
I started to go visit bank branches. And that's the eye opener for the rest of my career has been the one thing we can talk about is strategy. We can talk about the numbers, but what really makes a top performer is the execution of whatever strategy they've chosen.
Hmm. Yeah, totally makes sense. And I think even realizing, I'm sure you have at times, that what they say and what that execution actually is probably best experienced by seeing it, feeling it, touching it.
Well, one of my favorite stories was I was visiting a bank in the Midwest. It was still around. They were telling me how they use customer profitability to drive all of their customer service reps' actions,
Okay.
both in the call center and in the bank branch. And I just knew, or at least I had a feeling that that wasn't the case. I was really a little upset because at
Hmm.
this point now, I'd felt like too many bank management had misled me. Not that they did it intentionally, but that's what they wanted their people to do, but the people weren't doing it.
Sure.
So I literally took the elevator down from the executive offices on the 15th floor to the ground floor, went into the bank branch, and again, had a little chip on my shoulder, and I just went over to this woman who was on the platform, and I said, I don't even think I introduced myself. I just said, "Look, told that you have customer profitability information." And she goes, "Oh yeah, yeah, yeah. It's right here." She brought out this big old printout of everybody in the bank branch. Thing must have been 2 inches thick. And I go, "Well, how do you use it?" She goes, "Oh no, we don't use it because it's not accurate." And so, somebody will come in
Hmm.
and say they need some help over here, but I don't know if they have a mortgage with us. This is a bank that actually had a very large mortgage operation. So at that point, it just kept me being focused on really evaluating execution the best I
Sure.
could.
Have you seen many of the senior executives or CEOs that you have relationships with or talk to? Have they tried to do that themselves, or the undercover boss or secret shopper type of approach to just get a sense of like how accurate is our culture to what I think it might be?
Yeah, that's a great question because it's not as easy as you think.
That's right.
So there's one very large, one of our trillionaire banks, who had a CEO who would go around to the branches and he would give uplifting speeches.
Hmm.
And then he had a president, and the president would go to the branch and then to get behind the teller. Well, the tellers were scared to death that this guy, and he would say, well, the next time, for instance, why don't you ask Joe if he would like to talk to one of our financial services reps?
Hmm.
And so he thought he was providing coaching, but instead, the branch manager felt bad that the president was taking authority away, and
Hmm.
the teller felt terrible. So on one hand, the CEO just going and giving an uplifting speech about strategy and thanking him for working was great. On the other hand, bringing the president in
Sure.
to evaluate their work turned out to be a negative.
Yeah, totally. And I think that often, I mean, you know this, like people get into these echo chamber spots in their companies, and you can't get the actual, like no one's going to give the president that feedback of you terrify people every time you walk in here. Yeah, it's
Exactly.
so yeah, that's super interesting. Well, we were talking a little bit earlier about how the evaluation of a bank, while people try to have some of these universal metrics, the evaluation really requires a much more nuanced analysis. So as you think about today, you're a prolific investor in financial services. Do you have a framework or an approach that you consistently try to apply to a business that is continuously diverging in sort of how these banks look?
We use financial metrics to screen out interesting. Why is this company trading at this level, either positive or negatively? And then
Sure.
I try to understand the company because to me, as an investor, our primary decision making is my evaluation of the people on the other end. So if the major issue is growing their credit card business,
Hmm.
I want to know all the people responsible for making the credit card business grow. If it's a company that's had some credit problems, all I want to know is to deal with the credit people
Hmm.
and how they're
Hmm.
evaluating the problems they got into, how they're going to get out of them, et cetera. So where I spend my time varies, but it comes down to people.
Okay.
I'm making as an investor, I'm making a bet on people.
And do you find, like, as you look back or look forward, do you find that you've done better with people who've been in the role continuing to do the job and continue to do it better, almost like the growth story? Or do you find that you do better when it's a change in people from, the prior person kind of messed it up and the new person you think you can get behind to fix it? Is one of those led to better outcomes for you?
The because my business overreacts to problems,
Yes.
the bringing in somebody new to fix the problem usually is where we have made most of our money.
That's super interesting because I don't know I don't know that that's a universally true thing in business. Maybe it's, banking to your point and maybe overreacts.
I think investors overreact in banking, and banking it's pretty easy to turn around.
Hmm.
You just stop making the stupid mistakes you made before, you correct those, and then you go on.
Hmm.
So I do love as an investment strategy, because it's been a consolidating industry, when we can find somebody at a $50 billion bank that goes to work at a $20 billion bank, or somebody at $20 billion bank that works at a five, what I find is that they feel liberated.
Mm.
So the bigger institution that they worked at provides a roadmap for where the smaller company is headed,
Hmm.
but they can have more fun and be better managers because they try to eliminate the bureaucracy that they don't want to have at the smaller company compared to what they had at the bigger company.
That's so interesting, Tom. I mean, I've seen it, in a lot of the startups that I've been in, there's often that instinct to go try to find the person who's done it before and give them an environment to do it again or grow back into what they had done before. So get that, but I think that's an insight. I don't know if enough people appreciate and understand what you just shared there. So
But
that's
it's
really
not a
interesting.
guarantee. So,
Sure.
one of the things that, for instance, I'm in Philadelphia, and one of the greatest retail banks of all time was out here at Commerce Bank under Vernon Hill. And when he used to hire people from the bigger banks, and they would come in and be, say, branch managers,
Hmm.
you would always have to be on the lookout because they would bring a practice from the bigger bank that wasn't the practice of commerce, and
Hmm.
it was more compliance related, and it kept the company from providing the level of customer service that it was known for. So you can have a negative from bringing a guy
For
with
sure.
experience in a bigger bank into a smaller one. But in general, I have found it to be it's a great investment approach.
Super interesting. Yeah, I think the way I would characterize it is bring the best of what you know and leave the worst behind.
That's a great way to phrase it.
Yeah, it's like yeah, it never. I don't want all of it. I just want the good stuff. So
Leave the baggage behind. Leave
that's
the
right.
baggage.
That's right. Uh, so we were talking as well about how you've stuck with this and that the pace of change is faster, and I don't think it's slowing down. I think you would probably agree. How do you think about for your banks that you either are invested in or just even friends or those that you advise or write for, how do you think they should be showing up differently today than they were 5, 10 years ago?
I've just thought about this a lot in the last 6 months, and that's that the solutions to the change haven't really changed in 50 years. So 50 years ago, the banking was business was you offered whatever product you were legally allowed to.
Hmm.
You offered it in whatever geography you were legally allowed to, and you offered it at whatever price you were legally allowed to. And then gradually, there's been this deregulation, consumer behavior has changed, there's been increased competition from outside the industry, and yet every time, so the industry loses a little bit more each year to innovation,
Hmm.
and the solution's been focus on where we still as a bank, and in our particular bank, not all banks necessarily, but where do we add value?
Hmm.
And let's win there. Let's make sure we don't lose that customer base. Figure out where we need to be competitive, where we need to be not investing a lot of money, and in some cases, just where it's time to exit because there's been so much innovation that we're not competitive in that area.
Sure. So, and let's go back to this value topic because I totally agree with you. Do you think for most banks that value is still at the financial product level, or do you think the scope of value they should be providing needs to expand beyond financial products in a more explicit way than they've historically thought about it?
I think for the most part, if we take the $10 billion in less banks, the majority of the industry,
Majority of the ones that I get to work with day to day.
it's a relationship game still.
Yes.
When we publish our weekly, I get to see who reads it every week. And every week, Jamie Dimon reads.
Hmm.
So I say to him, Jamie, why do you read this? You got so much stuff that you can read. And he says, I don't care, Tom, what you write about the economy. I get much better stuff than what you write. So I'm not insulted by that. But he goes, what you write about are these smaller banks, and they do what I can't do.
Hmm.
And I think that's an interesting point. I think sometimes many of the people who work at a $10 billion bank, they feel intimidated
Sure.
by the JP Morgan Chases of the world. And here's the CEO of JP Morgan Chase saying, I can't do what they do.
Mm. So to go a level deeper there, do you think they need to keep raising their game? Like one of the things that I find in some cases, I feel like the relationship is still based on this we're in the same community type of relationship. It's a physical, we trust each other because we live in the same place.
Mhm.
And I look at it and say that's great. That is something that not everybody can do, but am I using all the potential assets I have? Like, am I being informed by the data of
Mhm.
what I see? It's not just our kids are at the same school or something. I should be studying, and technology can surface data to me now to help me be more proactive to you as a customer. And hey, I'm seeing a couple things that you might want to think about fixing or changing or improving in your business. Or am I looking at the industry you're in and saying, AI is going to have a really disruptive impact on the industry my customers in. How are they reacting to it? Is that creating risk for them and therefore risk for me if I'm a lender to them? Like, do you think that is the way banks should be thinking more to, I would even call it, enhance the relationship?
Well, maybe I'm going to twist that a little bit.
Sure.
Let's give it an example like homeowner associations.
Hmm.
Several banks have figured out of all sizes that because of luck or just circumstance, we service a number of homeowners.
Yes.
So that's if you become really good at servicing homeowner associations in your quote geographic market, that doesn't mean that you can't serve homeowners associations in adjacent or new
That's
markets.
right. That's right.
So that's the kind of the focus that I think
Hmm.
about. And the more that you focus on homeowner associations, the more value you bring to those, and then you bring in new customers. So
Totally.
it is a virtuous circle.
And would you consider then homeowners and associations as a customer segment? Would you consider that a quote unquote community?
Yes.
At, like, because I talk about this idea of stacking community. So you have your geographic one. Let's, you'll continue to try to build from there, but probably to your point, the banks that are doing well with HOAs probably have a lot of homeowners associations in the physical community they're in. And that's where it started because that's where they were. And then to your point, you start to build some expertise. Now you have a right to win potentially in other areas.
Yeah. But and everybody's going to be a little bit different. So in other words, the biggest banks, one of the reasons why they slip up is at a certain size, and that size is usually around the $15 billion level. They go from a relationship geographic approach to a line of business approach.
Hmm.
Now, you may have a automobile dealer that is better serviced by a large bank's automobile dealer group.
Hmm.
But you also may have in your geographic market an automobile dealer owner who wants to be serviced by the local bank because they want to talk to the bank president
Hmm.
and they don't really care for that last little expertise level that's higher at the specialist. So
Sure.
it's these trade-offs. Figure out where do I customer, what do they really want?
Hmm.
And if I am delivering, local relationship, that's where I got to win and expand from that based on the people who want a relationship like I can provide.
Mm. So
So I think
good. So if I'm primarily relationship banking oriented in 2025, do you think that should lead me to expand then services around that relationship to sort of protect and defend it? So should I be looking at private banking if I'm not in it or wealth management for that dealer owner if they want that relationship with the bank?
yes, but only to the extent that it's profitable
Hmm.
for the bank to do that. So are you going to compete against Northern Trust? Are you going to compete against Fidelity and Schwab? No. So, okay, somewhere between private banking provided the relationship and expertise, but not having the capabilities of the very highest. So that balance between more skill set for my target market
Mhm.
and not having an overload, not building a blast furnace when I need a mini mill is, I think, critical.
Yeah, I totally agree. On that note, who are you finding helps guide those decision processes? Is it the management team? Is it the management team with the board? Is it outside consultants that are often required to come in? I'm guessing in some cases they're coming to you and saying, what do you think we should do? Are you finding any consistency there in how they make good or not so good decisions?
No, I'm not finding
Okay.
consistency. And that's what I like about what you do. Because I think the toughest decisions for the size banks that you deal with is getting the information to make the partner decisions with vendors, whether they
Mhm.
be technology vendors or other supporters. Because what we've shown with the cost of data processing coming down,
Mhm.
that you shouldn't lose as a $5 billion bank because of technology.
Totally agree.
That technology is available for you. Making the decision as to which technology to vendor to go with is the biggest challenge that I see for your target market, which is why I like what you do, because you provide the research and development that they can't do internally.
Do you think they need to change the capability set they have within the bank, though, at the same time?
They do. And if nothing else, I say they need a better technology leader who's the go-between between the CEO and you. And that's the level that they don't typically want to add a person because they're not really, their charter is more nebulous
Yes.
than some of the other responsibilities. But I think that person to just be a scout is
Yes.
really important inside these banks.
Yeah, I would totally agree. I think one of the challenges I see is that if they haven't hired for it before, it's difficult to know what good or great looks like. And
I totally agree with that.
yeah, it's you're as likely to misfire because it almost feels like a new line of business to some extent
Right.
to have it.
And that's where they can come to you for
Hmm.
some help. They can go to Cornerstone
Sure.
Advising for some
Hmm.
help. So there are some firms that
Sure.
can help them with that.
Any is if I ask you, what is the biggest blind spot that you see a lot of senior bank executives have today?
Well, I only deal with publicly traded
Hmm.
companies. I shouldn't say that. 99% of my time is publicly traded companies. So the biggest blind spot for publicly traded companies, they don't want to take as much risk
Mm.
as I would like to see them
Does
take.
it feel like they're out in the open?
Right. They
Yeah.
just don't want to screw it up. They typically are, 60, 61 years old, and they're just trying to do this for another 4 or 5 years. And yet the entrepreneurs, so the privately held companies of the same size, are more likely to make that risk, which might mean lower earnings in the near
Short
term,
term. Hmm.
but help them long term.
Yeah, totally. No, and I saw that. I mean, I think the idea of going private at certain times in an industry's change and evolution is a way to really jump ahead.
Yeah,
Uh,
if my business really hurts, I mean, the typical $5 billion bank, may have one or two Wall Street analysts that cover them. They're the Wall Street analysts that work at the investment banks that are trying to get their banking
mhm.
business. So they're really not that good of research coverage. And yet the management sort of kowtows to what those two
Mhm.
research analysts want, as opposed to making better decisions. So I think in banking, not just publicly traded creates a problem, but because there's so many publicly traded banks that they become the wrong size, and that doubles up the problem.
Mhm. Have you started, you talk about people as a key factor. Have you started to layer in the technology team or lack thereof in a bank as part of your incorporation of, okay, are they equipped to move forward from here or not?
Yes. But to be honest, it starts with a CEO. And again, at the sub $10 billion banks, you see it right now with AI. I don't see the commitment at the CEO level of enough banks with less than $10 billion in assets to AI that I would like to see. One of the best decisions made in banking, and I didn't appreciate it at the time, was the summer of 23, when Jamie Dimon said internally, I don't know where this AI thing is going. I don't know how big it's going to be. We're not going to come up with a strategy now, but every one of you employees of the firm needs to get involved and start using AI tools. You'll get better at the tool, and the tool will get better. And then we'll figure it out.
Do you feel like at this stage, the CEO is your barometer, meaning if they're using it or not using it? I mean, I've challenged a couple of my CEOs to say, I think you should actually be the chief technology officer of your bank, meaning you should be well versed enough. I'm not saying you should be making the decisions, but you should, really good CTOs are strategists.
Right. I totally agree with that. So that the CEO, if the change is going to be as big as I think it's going to be, then there's got to be a better understanding about the development than we're currently seeing. There's got to be more commitment of time. And, it's tough because it's an area that you're uncomfortable with, but you've got to make yourself comfortable with.
Totally. Well, one of the things I totally appreciated about your conference too, Tom, was you showed both, here's a fintech that is a completely different business model that is being wildly successful in a niche, this consumer. You showed, one of the first really digital banks in an Ally, and that they have a different business model. You showed so many different ways that banks are growing. And one of the big takeaways for me is how much of a difference in marketing investment you see amongst different types of banks. So we were talking, a CEO should be a chief technology officer. I would also argue maybe that increasingly they should have a much better understanding about marketing strategy, marketing investment, ROI, because it's unbelievable to me that they might only be spending 1 or 2% of revenue on go to market. Like it seems like there's no way you're going to be able to continue to grow or not grow. So how are you thinking about the marketing investment and change that needs to happen there?
It's difficult. So what we see is the banking business is become increasingly technology and marketing driven. The marketing budgets at a typical bank represent 2% of expenses. They represent 5% at JP Morgan. They represent 12% at Chime, and they're 20% of the total expenses at Capital One.
Yeah, the disparity is crazy.
It is. They spend $1.3 billion every quarter, $1.3 billion on marketing. That's just on marketing. So somehow, as I'm putting my budget to bed for 2026, and most of them have already done this with the technology budget in the last few years. They've gradually increased the percent that they devote to technology, and that's got to continue. And the same thing has got to happen down here with marketing, and that's got to gradually increase. If it's 2% this year, let's make it 2.25% next year. It just has to keep moving. It's never going to get to 12% in 2 years, but it's got to move its way higher.
Where, like at Capital One, let's just say, who's dramatically different, where are they taking that budget from that other banks are over allocated to?
So people and places. So we've got to be, for the smaller banks, they've got to be more efficient. They're not going to close a bunch of branches. For the mid-size, whether it be large regional, super regional banks, they can still generate or change dollars of expenses from physical plant to marketing. But the smaller banks have just got to become more efficient.
Mm-hmm. Yeah, makes total sense to me. One of the things I thought was really interesting in the conversation last week too was how it was highlighted that some of the bigger banks like at JP Morgan or Fifth Third that are opening branches are doing it more efficiently, and the branch is not a strategy unto itself. It's being supplemented with a big digital marketing and brand effort in those areas as well. And I don't think most smaller banks understand that. They think the new branch is the strategy.
Yeah.
And they're not supplementing it, and they're probably not having the same output as this more, omni-channel or combined strategy. So how are you thinking about, are you able to suss that out or assess how they undertake their branch strategy?
Yes, I think there's a big difference.
Mm-hmm.
First of all, you have the three largest players, the JP Morgan's, B of A, Wells Fargo. They've got these consumer lending product businesses, and they have an asset management business that just is a natural advantage to move into a new market. And then you have the super regional banks, and most of them are not going to be successful with their branch expansion programs. They're not doing it the way a Fifth Third is doing it, which is you don't say I'm going to open 20 branches. You say I'm going to open one branch and learn from that. And then site location is so critical. And that's why many of those I think are going to fail, because they want to open 20 branches in a new market, and yet they haven't spent and they won't spend the time to invest in the right locations. Vernon Hill once said to me, because I went around visiting branches with him in his car, I thought I might learn the secret to opening these great branches.
Mm-hmm.
And his business before he became a banker was he picked site locations for Ray Kroc and McDonald's.
Well,
On the East Coast. And so what it was that's just what that was in his DNA.
for sure.
And it's just not in a lot of people who work at banks. It's not in their DNA to be great retail space locators.
Well, one of the great stories I feel like of business was how, like, McDonald's, one of their strongest capabilities was picking locations, and then Burger King's best strategy was just buy catty corner wherever McDonald's was, and they had a much smaller team. I think that's one of my favorite all-time business stories was, you take that strategy, we'll employ the one that we think we won't do it better. We'll just follow you.
It's kind of like JP Morgan has a similar approach to Chick-fil-A's.
Yeah.
So they love to locate one of their new branches close to a Chick-fil-A.
Makes a ton of sense. That is a retail storefront that is always busy. I think they can drive that traffic even at times. So let's talk a little bit about data. So we talked about, the CEO today probably needs to understand technology better. They need to understand marketing better. How do you determine the data competency of a bank executive today?
That's one of the biggest changes at this year's conference compared to prior years. Prior years, the opinion would have been, so let's say over the last 5 years, that we want to do all these new things with data management, but we don't have a clean data set.
Mm-hmm.
We can't get our data to talk to each other. The consumer loan products don't talk to the deposit products, things like that. And one of the outcomes of this year's was the number of companies that admitted that they overinvested in a data management effort,
mm-hmm.
and that because of evolution, that they can get much quicker. They can get there much quicker today at a lower expense. Okay. So managing the data is still very important. It's still critical, but we can do it cheaper.
Yes.
And simpler today than we thought 5 years ago.
Yeah, I totally agree. Like the multi-million-dollar data lake investment, agentic AI is very quickly rendering that unnecessary. And what I tell a lot of my banks is, you're actually fortunate you didn't go make that big investment and have this sunk cost. Now you can actually do it within this really ugly architected legacy system environment you have and quickly catch up.
Yeah. That's what, some of the vendors that we had there, some of the fintech
Mm-hmm.
companies, whether it be Encino or Blend, they are certainly highlighting that as a capability that they can provide to
Mm-hmm.
their clients.
Let's talk a little bit more about talent, Tom. So, if you're a bank today, how do you think about trying to attract and retain this next generation of talent? I've got three kids in college or about. They're a digitally native future workforce. Like, how do you convince these digital native, really capable, smart kids to go work in community and regional banks?
Funny thing is, they they work with a lot of data. They can work with a lot of data.
Mhm.
So again, if you're winning, if you have that right strategy, you become you're not a boring bank anymore.
Mhm.
You're an exciting bank because you're allowing somebody young to come in, take a look at this data, use new tools, and come up with better products and
Mhm.
services. So now I don't find the majority have that approach, but certainly that's one approach that's a benefit of being bigger today.
Mhm.
So it is working its way down, but there's no reason a $5 billion, $10 billion bank that can't be a selling point to attract people.
I totally agree. And I think it's not highlighted enough what you get, especially in a smaller bank like that, what you get to do. I mean, you get to potentially get exposed to all kinds of businesses and just see really interesting things happening in your community. Like
Yeah,
that, I think it's a great way to learn about business for somebody coming out. But I don't think banks do a great job often of telling that opportunity story.
right. But that's part of the mindset shift that's slowly taking place.
Hmm.
I'd say we had this period of dramatic change, and really in the last 15 years, it just keeps accelerating. So I'm more optimistic because it's not 15 years ago when we're really beginning the exponential part of this curve. We're pretty well along on
In
this
it. Hmm.
exponential part of the curve.
What's your prognostication for the consolidation underway? Like, do you think we're half as many banks in 10 years? Do you think that is going to pick up, or are you any thoughts there?
So really, since 1985, the rate of consolidation as measured by the banks acquired in any 1 year relative to the beginning of the year's banks, that was the peak, the heyday for consolidation was the 1990s.
Hmm.
We did about 4%. The last decade, we've done about a little over 2% per year.
Hmm.
In the 80s, we did about 3%. So somewhere between 2 and 4%
Hmm.
of the 4,400 banks that are left, I think is what we'll
We'll
continue to see.
continue that. Yeah. Yeah. One of my partners believes that that's really the infrastructure that's set up to support that is like it's actually efficient, and that's probably the at times I just go, okay, is technology going to make that possible to go faster or something? I don't know. I think, but I totally appreciated your views that scale is not always the right answer either, and has not been a predictor. I thought that was a really great insight that you've been able to glean. The scatter plot chart of performance is a great way to indicate that
And that's
it's
been
not
the
obvious.
case, it's not just here in the United States forever, but it's been the case outside the United States, much more consolidated banking sectors. But there is one big difference. So in the early part of 2000, when there would be a consolidation and good bankers were not happy working for the bigger company, they would go out and start a smaller bank.
Hmm.
We would have 100 to 200 in the early 2000s new
Hmm.
charters every year. And really, since the crisis of '09, we haven't had double digit charters. I think last year there might have been one.
Hmm.
So it has really been low single digit numbers since then.
Do you think there's a model to start new banks still?
No, I've always said that. I've said for the last 10 years that if I was head of the FDIC and you came to me for a bank charter, that I would deny you for being that stupid that you. So,
Yeah.
but there have been, again, that's an overreaction.
Yes.
You have a niche market that you can.
Mhm.
There will always be, a place for you. I
Sure.
think going back to some of Jamie Dimon's comments, he wants to beat the heck out of the super regional banks,
Mhm.
but he realizes that there'll always be a spot in this country for thousands of community banks.
Mhm. Yeah. How should community banks, in your mind, think about the threat from non-banks, technology companies or others? I think the hard part in many cases is it feels like almost a hidden threat to a lot of them. They don't see them. I've had banks tell me, oh, I've got a couple other banks in my market, but I keep an eye on them. I'm not worried about PayPal or these other, tons of name Chime and other non-banks. How do you think they should be thinking about or paying attention to that group?
Start by thinking about it.
Hmm.
So, in other words, if I do believe that these neobanks, and I like to use Chime as the best example, has said, we are Nucor, and you established banks are
Yeah.
US.
Yep.
And we know you can't make money servicing this customer base. But in the case of banking, that customer base is half of the US citizens.
It's a lot.
Okay, so my target market where I make money today is not going to be that base. I can't fight the Chimes of the world with my existing business model. So I have to figure out, do I want to completely abandon that market? Do I want to let that market atrophy? How do I want to handle that? Right now, unfortunately, I think there's too many banks that just don't have a strategy. They don't
Mhm.
recognize that there's a difference between 50% of the population that lives paycheck to paycheck, and you can't make money off of high balances and fees.
Mhm.
They're going to those neobanks.
Mhm. I think that's great advice. I mean, it also, to me, embedded in that is you have to study the data both in your customer base, in your market, and really I use the term data informed. Is you don't have to be solely data driven, but if you're not being informed, if you're not bringing it into the room and you're just making decisions off of opinion and other things, then you're going to get the outcomes you're going to get. And good luck.
Right. Yeah, I agree.
Yes. Well, Tom, this has been super fun. I am not going to let this be the single episode because, as you said, this is moving and changing faster than ever. And this conversation will have a continued relevance for the foreseeable future as far as I'm concerned. And I think we're both in the middle of something that's really fun to be a part of. And not everybody's going to win and not everybody's going to lose, but there is guaranteed interesting change and opportunities ahead.
Let's do it again.
Sounds great. We'll talk soon.
Take care.
Thank you for listening to this week's episode of Operate Podcast. If you like this conversation, as a favor to me, you can rate us, review us, or subscribe, or tell your friends. You can also reach out to us on Twitter at Operate Podcast. Until next week, get out there and operate.